When you invest and make a profit, it feels like a win. But before you start planning how to spend those gains, there's something you need to know. Capital gains tax. No matter where you live, if you make money from investments, the state will almost always want to share. But how much do you actually get to keep? And why do some countries tax your profits more than others? Let's break it down. Capital gains tax is what you pay when you profit from selling an investment, like stocks, bonds, or mutual funds. It also applies to dividends from stocks and interest from savings accounts. The rules and rates can be surprisingly different depending on where you live and even the type of investment you choose. But first, a little history. The idea of taxing profits from selling assets goes back to ancient times, but the modern capital gains tax really took shape in the 20th century. In the United States, capital gains were first taxed as ordinary income in 1913. That meant your investment profits were taxed just like your salary. But by 1921, Congress decided to encourage long-term investing by capping the tax rate on gains from assets held for more than 2 years at 12.5%. This made holding investments for longer more attractive. Europe took a different approach. Germany, even before World War I, taxed quick profits from selling assets held for less than a year. The goal was to discourage speculation and make sure the state got a cut of fast money. The UK, on the other hand, didn't tax capital gains at all until 1965. Since then, countries have continued to tweak their rules, sometimes to encourage saving, sometimes to raise money for the government. So, how do different countries tax your investment profits today? Let's look at a few examples. In Germany, the tax rate on capital gains and dividends is about 26.4%, no matter how long you hold the investment. There's a small annual exemption if your gains are under 1,000 euros, but otherwise, the rate is fixed. Brazil uses a sliding scale for fixed income investments. The longer you hold, the less you pay. Hold for less than 180 days, and you'll pay 22.5%. Hold for more than 2 years, and the rate drops to 15%. For stocks, the rate is 15% for most trades, but day trading is taxed at 20%. There's also a monthly exemption for small investors. Spain taxes capital gains between 19% and 28%, depending on the total amount you earn in a year. There's no benefit for holding investments longer. The more you make, the higher the rate. The United States makes a big distinction between short-term and long-term gains. If you sell an investment you've held for less than a year, your profit is taxed as ordinary income, which could be as high as 37%. But if you hold for more than a year, you get a break. The rate drops to 20%, 15%, or even 0%, depending on your income. This makes the length of time you hold an investment a critical factor in how much tax you pay. France applies a flat 30% tax on most investment profits, but there are special tax envelopes like Assurance V that offer lower rates if you invest for more than 8 years. Italy charges a flat 26% on most gains, with a lower rate for certain government bonds. The holding period doesn't matter. Luxembourg offers a unique deal. If you hold an asset for more than 6 months, your gains are tax-free. Sell sooner, and your profit is taxed as ordinary income, which can be as high as 42%. Portugal encourages long-term investing by reducing the tax rate the longer you hold. Start at 28%, but after 2 years, part of your profit is exempt. And after 8 years, the effective rate drops to under 20%. The UK gives you a tax-free allowance of £3,000 per year. Above that, the rate is 10% or 20%, depending on your income. And if you invest through an individual savings account, or ISA, all your gains are tax-free, no matter how much you make or how long you invest. Sweden taxes most gains at 30%. But if you use a special account called ISK, you pay a small annual tax on your invested amount instead of your actual profits, which can be a big advantage for long-term investors. Switzerland stands out by not taxing capital gains from securities at all, no matter how long you hold them. However, dividends and interest can be taxed at high rates, depending on where you live. Ukraine applies a flat rate of about 23% on gains, with a small exemption for very limited sales. So, what does all this mean for you? The amount you keep from your investment profits depends on where you live, how long you hold your investments, and the type of account you use. Some countries reward patience with lower rates or exemptions. Others offer special accounts that shelter your gains from tax altogether. If you're planning to invest, it pays to understand your country's rules. And while you can't always choose where you pay tax, knowing the system can help you make smarter decisions and keep more of your hard-earned gains. For more details, check out the full article on the My Friendly Budget blog. If you found this video helpful, give it a like, subscribe, and visit myfriendlybudget.com. Start building a brighter financial future today.